Hello guys, welcome to another episode of Daramala Talk Finance, and in today's video we'll be talking about how to become among the 1% of the population that outsmart the world. You may ask me by saying, what do you mean by outsmarting the world? It's simple. The reason why they're among the 1% is because they make financial decisions that made them among the 1%. They made excellent financial decisions that made them among the 1% of the world. So it's a level of choice. So what do you want to be? Do you want to be among the 99% or you want to become among the 1%? If you want to become among the 1%, then stay tuned as you watch. Alright, welcome back. In the next segment of this video, I'll be showing you how the money moves in the financial market between the surplus agent and the deficit agent. It's going to be an exciting one. So stay tuned as you learn how your money works or how the money moves around the economy.
Hello and welcome back. And in this image, I'll be explaining to you how the money moves in the financial market, how your money moves from one economic agent to the next economic agent. Now, there are two things I want you to observe in this diagram: the savers and the borrower. The borrower is called the deficit agent and the saver is called the surplus agent, meaning they have a lot of money and they don't know what to do with the money. You might say, I save money, but I don't have a lot of money, but that's what you're doing, because the little amount of money you keep in the bank, it means you don't have a use for it, or you don't know how to manage that money, so you just decide to keep it in the bank, right? So you are the saver. So this is the saver. Now, the saver, let's say at the end of every month, you're paid a certain amount of money and you decide to save some of it in the bank. Now, a saver, most of the times, they think this is the best thing to do. So they take their money and they save it in the bank. Now, but there are other more smarter decisions you can actually make, or there are more smarter decisions you can take with your money. So we have some savers now that invest their money with a fund manager. So they invest their money with a fund manager, maybe a hedge fund manager or a financial advisor that tells them what to do with their money. Now, it's also possible that this saver can also invest in the bond market. So a company wants to raise amount of money. Now, the way the bond market works is that a public company or a company want to raise, or the government want to raise amount of money, and they don't want to sell the shares of the government businesses, or the public business does not want to sell their shares. So what they decide to do is that they just want to take $10 billion loan from the public, and at the end of the period of the bond duration, they're going to give back whoever loaned them that money, their $10 billion. But within that intervals of the 3 years, they're going to be paying interest on whatever that is borrowed. So I want you to get the difference between the bond market and the equity market. But in the equity market, the guys or the owners of this company are interested in raising money from the public, but they want to do this by selling a percentage of their company. So you can now go to the market to buy a share of Google, or you can buy a share of Tesla, or you can buy a share of Nvidia, or you can buy a share of Coca-Cola, you can buy a share of Greg's, you can buy a share of some company, Greg's, whatever country you're listening to this video from. You can buy a share of your company, of a public company traded in your country. So a saver can be smart to invest in the bond market, and a saver can be smart to invest in the equity market. Now, it's also possible that savers also have money with the insurance company, meaning that they tell the insurance company, the way the insurance company works is that you give them a certain amount of money to insure an asset. Let's say your car, your house, your appliances, even your life. You get the point. So at the end of every month, there's a particular amount of money you're contributing to the insurance company. So that money is called the insurance premium. Now, on the case of damage, on the case of thefts, the insurance company are going to give you back whatever it is that you have lost. So there's a cover for whatever that you have lost from that premium you are contributing to the insurance company. So now, I want to ask a question. Let's say, for instance, you bought a car, and after 6 months of your contribution to that port, the car had an accident. Now the cost of the car is $30,000, but you've just contributed, let's say you just contributed $1,000. Now I want to ask you a question: how would the insurance company be able to pay for the brand new car? knowing fully well that you've not contributed up to half of the cost of that car. What it means is that whatever money you are contributing to the insurance company, they are actually managing your fund so that the money can actually grow. Of course, it's a pool of funds from different people that are saving with the insurance company. But I want you to know that the insurance company have experts that manages your fund. So what they do is that they invest your money in the equity market. So you can see that insurance company also are smart people. They invest their money in the equity market. They can also invest their money in the bond market. They can also invest your money in the equity market. Now, when you're working for an organization, let's assume a particular amount of money is contributed towards your pension, towards your retirement. Now, this money goes to the pension fund manager. Now, the pension fund manager manages your money by investing it in the equity market and also by investing it in the bond market. So you see how this money flows. You see how people are making wise decisions with your money. Or the money you're contributing to them, they're taking advantage of that money, investing so they can get more money to be able to serve you and also pay themselves. Now, I also want you to notice something from the deficit agent, which are called the borrowers. Now, I said the deficit agent are either the banks, they're either the government or owners of businesses. So the money you use in buying bond, that money is given to the borrowers. So the borrowers decide that I want $10 billion. I want to get this money from the bond market. So you say, okay, Google is having a 10-year or 3 years bond that they are selling out to the public. I want to invest in that bond. So you give them $10,000. Now your $10,000 goes to Google, which is the borrower. And what Google does is that they give you a certificate to show that, yes, we are owing you $10,000. And at the end of 3 years, we are going to pay you back your $10,000 and we owe you nothing. Now, Google also make money from the equity market, for instance. So Google wants to sell 50,000 shares of their company and you're interested in investing in Google, so you give Google $5,000. So Google say for $5,000 you're going to own 10 shares, for instance. Now they give you a certificate to show that you are part of the owners of Google. So Google give you a percentage ownership of their company and they take your $5,000 from you. So Google have gotten $5,000 from you. Google have gotten $10,000 from you from the bond market. I just wanted to see that is why they are called the deficit agent. They need more money. So they can take money from the equity market, from the bond market, and they can also take money from the equity market. And they can also decide to go and borrow money from the bank. So this is exactly how money flows in the economy. Now, some people are smart to take advantage of this system, but some people are not smart to take advantage of the system. And that is the 1% that are smart, 1% of the population that take advantage of this system to make money for themselves. Now, look in this diagram and picture where you can find yourself so that you can always be at the 1%.
Alright guys, I hope that was an exciting one and I've been able to prove to you between how money flows in the financial market from the surplus agent to the deficit agent. The surplus agent is the borrowers. Sorry, the surplus agent is the lenders, those that save money in the commercial banks, and the deficit agent is the borrowers, those that borrow money from other sources like the bond market, from the equity market, and also from the banks. Now, I just want you to understand now that it is important you smart the system based on that image. If you don't understand it, please do well to scroll back so you can be able to understand how the money moves from one economic agent to the next economic agent and how you can be able to outsmart the system, taking advantage of how this money flows, and picture where you can actually be either in the surplus agent or in the deficit agent. Now, I did an interesting research between Monzo and Lloyds Bank. Now, Monzo Bank is a fintech bank and Lloyds Bank is the brick and mortar banks that we all know about, like the NatWest and the Lloyds Bank, the Bank of England, and all of that. They are all brick and mortar banks. Now, people may say, I don't like the fintech bank. Some people may say, I like the brick and mortar bank. That's a different choice. But they are all banks and they are all good. It just depends on your preferences. Now, I want you to understand something. I did a research between three things. The first is how much are you paid on interest when you are saving your money in Monzo Bank and in Lloyds Bank. For Monzo Bank, you are paid between 1 to 4.9% on Monzo Bank. Now, in Lloyds Bank, you are paid between 1 to 4% on interest for your savings in the bank. That is if you don't withdraw the money. Now, the reason why it's between 1 to 4.9% is because there are trenches. There are trenches. So between, let's say, £1 to about £3,000, you are paid between 0 to 0.99% return on investment if you're saving your money there, right? Now, if you go higher, the more it is, but the maximum in that trench is 4% or 4.9% for Monzo Bank, and for Lloyds Bank is 0 to 4%. Now, I also did the research for credit card. If you're taking a credit card loan, you are paid in Monzo, you are paying the bank for the credit card or whoever lends you that credit card. Now, Monzo and Lloyds you're talking about. For Monzo, it's around 29% APR, annual percentage rate you are paid for that credit card. Now, let me explain to you how the credit card works. The credit card is just like a lender that gives you money. So you can do whatever you want to do with the money, but you just make sure that you pay back that money before that duration of paying back reach. So let's say you pay back the money you spent, you're supposed to be charged 29% at 15th of August 2024, for instance, but you paid the money, whatever you spent, you paid it before 15th, or let's say you pay it at 13th of August 2024, so you don't get charged. But the moment you elapse that duration, let's say this is 16th of August 2024, and you have not yet paid it, what you begin to pay is 29% of whatever you owe. That's what I mean by that. So for Monzo Bank, you are charged 25% APR. For Lloyds Bank, is the minimum based on the credit card type you're taking is around 10.9%, which is about 11% on APR. Now, if you want to take a personal loan from between £0 to about 25,000, of course you can't take £0 loan, but let's say between £1 to £25,000 is between about 7% APR. Now, the higher the amount of loan you're taking, let's say for a commercial business, it may be lesser than 7%. But I want you to understand the differences here, because those that are actually borrowing money from the bank, which are the deficit agent, they are getting this money way cheaper, right? Because they are borrowing money from the bank, and the bank take advantage of a huge amount of savers' money. Remember, you are being paid 0 to 4%, but whenever you are taking a credit card from the bank, you are paying to the bank between 10.9% to about 29% APR. So I just want you to see the difference. So now, act smart and think wise. How can I take advantage of this gap? That I am not among the losers, but I want to become among the winners by being among the 1% of the smart people. Now, this is it. You may ask yourself, all right, I'm not interested in doing business. But I want you to know that even as a saver, rather than saving your money in the bank where you are paid between 0 to 4%, you can actually invest your money. So you can invest your money in the equity market, you can invest your money in the bond market. We've explained in the image that we analyzed previously on what the bond market is and what the equity market is. So you can decide to buy the shares of Google, you can decide to buy the shares of Greg's, you can decide to buy the shares of McDonald's, you can decide to buy the shares of a biotech company, you can decide to buy the shares of Barrick Gold, whatever company you're interested in. You can decide to buy the shares of Nvidia, of an artificial intelligence company. It just depends on your choice, right? You may decide that, okay, I don't know how to invest in personal companies, individual company. I want to invest in an index fund. An index fund is a basket of companies that is placed in an index. So we have different index. So we have the S&P 500. It's called the Standard & Poor's 500, which is the top 500 companies we have by market value in the United States. In the UK, we also have FTSE 100, FTSE 250. These are index of the top 100 companies or the top 250 companies we have in the UK. You can also invest in NASDAQ 100, the top 100 tech companies we have in the UK, in America, sorry. But you can also invest in the Dow, which is like the top 30 tech companies we have in America. These are different indexes. We have CAC, different for different countries. So whatever index, now you can make your research to see what are the annual return on investment of these indexes. On average for the S&P 500, it has returned between 8 to 10% or even more. In the past 10 years, it has returned more than 10% annual return on investment. Now look at this. You invest in the index market. for instance, and you are getting 10% return on investment. But if you're saving that same money in the bank, you are getting between 1 to 4% annual return on investment. You can see that it is 6% way difference, right? 6% different. And these banks take your money and they give it to these borrowers, and they charge these borrowers 7%. And they also charge these borrowers between 10.9% to 29% on credit card loan. I just want you to think of it and just act smart. Whatever you think is best for you, based on what I've said, you can make a decision. You can also decide to invest in the bond market. The bond market has returned between 4 and 5%, and in the past 10 years, it has even returned more than 5%. So you can invest in shares of company, you can buy the index, you can also buy the bond index. Whatever you want to do, you can decide to do it as a saver, being a surplus agent, rather than investing your money in the bank, right? Also, you can decide to become a deficit agent. What do I mean by deficit agent? You can start using other people's money. You may say that I don't want to take loan, but we have two types of loan. We have good debt and we have bad debt. A good debt is when you take that money to invest in a productive asset, not a liability. Watch my previous video between the difference between asset and liability. That's one of the videos I've released. You can watch it maybe somewhere here or there. You can see the video displayed on the screen. But I want you to know that if you invest your money in asset, and that asset is a good asset, it returns to you money that you can actually use to service back that loan. So you can decide to start up a business. You can decide to start up a real estate business. Go and learn about real estate. Go and learn about how to invest in commercial property. Go and learn how to do HMO, different kind of real estate investment strategy, right? So when you borrow money from this bank, you are even giving an interest rate that is much more flexible, right? So you can actually use other people's money to invest in your ideas by also starting up a business. And who knows, that company can grow big to become a public traded company, so you can sell your shares to the public, so you raise money from the public to invest in your business. Or you can also raise money by selling out bonds, right? At the end of whatever period of time, you pay back whoever borrows you the money, right? But you have taken advantage of the public money to invest in your business or invest in your idea. If you also are not taking your business public, you want to start up an idea, there are people that may be interested in what you are doing, right? And they will want to invest their funds in your business. You can just give them a little percentage or portion of your business as the business grows. But I want you to don't think of it. You can either become a deficit agent, be a borrower, or become a surplus agent by being a saver, but rather invest your money in these channels. So the choice is yours, but I want you to act smart so that you can be among the 1% of the population that are making smart decisions with their money. All right, until the next time, I want you to stay tuned. Please don't forget to like, share, and comment, and also click on the notification bell so you can be the first to receive our video when next we shoot the video. Of course, very, very soon you see the next video. And also, if you've not watched our previous video, please do well. Like I just talked about the asset and liability. Please do well to watch those videos. You'll be surprised. There's a lot of tons of things you're going to learn that is going to boost your financial intelligence so you can make best financial decisions with your resources. All right, until next time, don't forget to stay green. All right, cheers and bye for now.